In this lesson, you're going to learn about the expanded accounting equation. But before we do that, let's go ahead and take a look at the accounting equation. Assets equals liabilities plus owner's equity. And I want to do just a quick review looking at just the accounting equation before we get to the expanded. So let's go ahead and do these three transactions. The owner invested $20,000 into the business. Owner invested, I know that's the capital, and when the owner invests money, that owner's capital goes up. And invested what? $20,000. So cash in bank goes up. Now, I want you to be aware that anytime, like we've done in the past, anytime you affect owner's equity, you need to tell me why. Make it a little bit easier, and it will kind of get you to understand the expanded accounting equation. So the owner invested, or I should say it was an investment, and it affects the capital. B, business paid employees wages $5,000. So if the business paid an employee wage $5,000, we know that the cash in bank goes down, and you paid it, so it kind of makes your capital, the owner's equity, goes down because that's money that had to leave your pocket to pay expenses. So minus 5,000. What's the reason? Why did you affect the capital? That was an expense. C, customers paid company for services provided. So you provided a service and your customers paid you. If you provided a service, you generated revenue, so that's going to make the capital go up. Why did you affect the capital? This transaction was a revenue. So I want to just focus on the owner's equity part of the equation. Owner's equity, there's basically 4 ways that we're going to affect owner's equity. Think of that capital account. We've only been affecting the capital. The capital is increased when the owner makes an investment. So that is the only time I want you to affect the capital, okay, is through an investment. So this would be your capital account. The other way that owner's equity is increased is through services provided or revenue. Now there's a couple ways that owner's equity is decreased. One is the owner takes money out for personal use. We're going to call that the drawing account. And some of you can put withdrawals. I'll use them interchangeably, drawing or the withdrawals account. And the other way owner's equity is impacted is through expenses, which will decrease owner's equity. Okay? So basically now we have to keep track of these separately so we can keep a running total of how much we paid in wages, how much revenue did we receive, how much did the owner withdraw, how much did the owner invest. So we have to create separate accounts. So here's what the new expanded accounting equation will look like. You still have your assets, you have a bunch of accounts in the assets, cash in bank, supplies, accounts receivable, and then you have your liabilities, and then you have your 4 equity accounts, okay? Kind of. These will actually be called revenue accounts now, and these will be expense accounts. So you've got the capital, which is your equity, because these will actually eventually get dumped into your capital, but throughout the accounting period, we do have to keep them separate. Okay? So what I want to take a look at is some accounts names that actually go under here. So your capital is your capital, your drawing money you take out for personal use, is your drawing account. And then we've got revenue accounts, and you could have lots of different revenue accounts. You could have fees earned, you could have service revenue, you could have delivery of revenue, and the list goes on and on and on. And then you've got your expenses, and we do have to separate them. We've got rent expense, we've got advertising expense, we've got utilities expense, and the list goes on and on. So we're going to keep track of each of those separately. So I'd like to go ahead and try some transactions. So you'll need your handout, and let's take a look. The transactions do start on page 10 of your book, so if you want to follow along, I'll kind of go through them with you. Page 10, the first one says, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions. So, $25,000, I don't want that. Sorry. Okay, you shouldn't be putting dollar signs, so I had to get rid of my dollar signs. The owner invested $25,000, so we know that equity is affected, but what account in equity? Chris Clark Capital. Only investments go in the capital account from now on. So this would be $25,000. 25,000 equals 25,000. Looks good. Next, B. And this is found on page 11. Net Solutions paid $20,000 for the purchase of land as a future building site. Net Solutions paid $20,000 for the purchase of land. Well, let me get my land account in here. So we're just going to insert an account, and this is actually, if I keep it color coded, will be. So if Net Solutions bought land, our land account goes up $20,000, and our cash and bank goes down $20,000. And then you can see that I do have my formulas at the bottom, so I can still see that 20,000, 25,000 equals 25,000. All right, C. Net Solutions purchased supplies for $13.50 and agreed to pay the supplier in the near future. So you bought what, and how'd you buy it? You bought supplies, $13.50. How'd you buy it? You took out a loan. So you charged it. So you owe your creditors more money. And if I take a look, and if you look in your bottom corner of your screen, you will see that the total, if I highlight these, equals $26,350, and on the other side of the accounting equation, these two equal $26,350. So you should always be making sure that your assets equals your liabilities plus your owner's equity, and a balance. Okay? D. Net Solutions received cash. So if you received cash, you have more cash. But why did they receive more cash? Of $7,500 for providing services to customers. So you have more cash, but you provided a service, and usually we've been putting that in the capital and telling why we affected the capital. Well, this one we know this was an investment. That's the only reason we'll use the capital, but this time we provided a service. And our service is fees revenue. It's the fee we charged to our customers so we could earn some money. So it's fees earned. Don't think of fees that you pay. Think of fees that that you charge your customer. So our revenue goes up. And this was a positive, so this has to be a positive. And if I click from here to here, 33,850 equals 33,850. And if you can't see that, you don't know where I'm getting that, at the bottom right of your bottom right corner of your screen, let me know. All right, E, turn the page. E, Net Solutions paid the following expenses during the month: wages, rent, utilities, miscellaneous. don't know the total until I add them all up. So what did we pay? We paid wages of 21.25. So wages makes my equity go down, so I do have to minus that. Rent was 800, so it makes my capital or my owner's equity go down. Utilities 450. And I hate this account. I wish your book didn't use it. The IRS doesn't like it. Why did you use miscellaneous? You should just make an account, but we'll deal with it. So if I take this, highlight all four numbers, look at the bottom of your screen, we just wrote checks that totaled $36.50. So our cash went down $36.50. So a negative $36.50 equals a negative $36.50. Okay. Next, F, net solutions, paid creditors on account. So if you paid creditors, your cash and bank goes down. Here's my creditors, $950. All right. This one's a hard one. G, Chris Clark determined that the cost of supplies on hand at the end of the month was $550. So I need this number to equal $550. So $1350 is what they say we have on hand, but we really don't. We've used up some supplies. So if you used up some supplies, we've got to expense them out. So we have to take the asset of supplies and make it an expense. So if I take equals $1350 minus $550, right? Oops, what happened? Equals $1350 minus $550. Okay. So $1350 minus $550 gives me $800, but I have to take it a negative because I'm taking it out. So it becomes minus $800. So $1350 minus the $550 because that's what I have still on hand. Still on hand is the ending balance is $550. So minus $800, take it out of there and get that over here as an expense because you used up some of your supplies. You've used up $800 worth of your supplies. And the last one, H, Chris Clark withdrew $2,000 from Net Solutions for personal use. So if he withdrew, he took $2,000 out of the business, and that would be his drawing account. Why? If you're going to affect owner's equity, it's no longer just the capital. So I minus the $2,000. So if you take a look, and I highlight my asset balances, oops, you will see that they equal $26,450. Highlight these over here, equals, $26,450. What happened? So $26,450 equals $26,450. What had happened was I added this column and I forgot to put my auto sum here, so it wasn't adding that up. So I do balance.